On behalf of First Mark Credit Union, I want to welcome all of our participants to the first of what we plan to be regular and recurring investment webinars offered by our new investment advisory partner, TCG Advisors. We're excited to bring this timely webinar to you in what has certainly been a unique year on many fronts. We're equally excited about partnering with TCG to provide you with an investment advisory firm that provides quality information and advice to help you achieve your investment objectives. First Mark selected TCG as our investment advisory partner because of their expertise, as well as their focus on serving our members in a fiduciary capacity, which means they always act in your best interest. TCG has been widely recognized as a top financial advisory firm by top financial publications such as Forbes and the Financial Times. They offer a broad range of services to members from a variety of backgrounds, and they also have deep experience working with school districts and their employees to provide expertise on TRS, as well as 403B and 457B investment accounts. Our presenters today are Dennis Bielik and Matt Anderson. Dennis Bielik is a managing partner of TCG Advisors and leads the investment team. He joined TCG after serving in various leadership roles with TD Ameritrade and Charles Schwab. Dennis holds Charter Financial Analyst, Certified Financial Planner, and Financial Risk Manager designations. He is a published author with his book, Money Management Mindset, How to Plan for the Expected and Unexpected. Matt Anderson is TCG's head of tax planning and a senior wealth advisor. He's a former professor at University of California, San Diego, and holds certified financial planner, enrolled agent, and accredited investment fiduciary designations. Matt works with clients to implement tax saving strategies to maximize after-tax returns on investments, as well as estate planning and strategies. I'm sure our participants will have questions for each of you at the end of your presentation. So without further delay, I'm pleased to hand the program over to Dennis Bielik. Dennis?
Thanks, Greg. We really appreciate it. And thank you everyone for taking the time to listen to us today and view the webinar. TCG is really excited about the partnership and about being able to start these programs ongoing for y'all. Our focus today is to go through a little bit about who TCG is, what we've seen in the investment markets this year, what we're seeing going into next year, and also how we feel the election will impact investing and what you should be looking for. And then we'll change it to planning and some of the estate and tax planning implications that the election may occur, as well as some things you should be looking at for this year as well as going into next year. For those who have not heard of TCG before, Trusted Capital Group, we are a large RIA, and we have specialized starting off with public sector, mostly school districts. So for those that work in a school district, we've worked with over about 1,000 school districts across the country, but we do specialize in Texas with TRS. We also do specialize in TMRS for cities and county employees, as well as ERS under the employment retirement system there. You know, our focus has always been to always take a fiduciary standpoint and do what we can to help people outperform retirement. And that can be from understanding individual situations, helping people budget, helping people manage their debt, but also how to invest and plan for a lifetime, as well as for legacy planning. And so throughout that, we've expanded offices, and we do offer services in Spanish as well as English, and we have a team of certified financial planners throughout Texas that are here to help each and every one of you with your needs. As you can see here, we have 5 offices throughout Texas, as well as we have over 100 employees here to assist every one of y'all. So one of the quotes we wanted to start off today as we dive into the market is, "We don't have to be smarter than the rest, we just have to be more disciplined than the rest." By the famous Warren Buffett. And this year was very unique, and one that definitely will stand out for the record books. If you look at volatility this year, we've had more 4% up and down days than we've ever had in history. And this was actually going into just the end of June. We have not seen a 4% movement day since June. But this is more than what we saw in the year of the Great Depression. And so it's a very unique time frame. However, if you look at where the market is today, if you just held steady and didn't panic, you would have been okay. But even more interesting is typically how does the market do after those major days? And you can see 3 of them highlighted here as far as the worst market days in history happened this year. We see 12% down 9.5, down 7.6. But as you can see, every one of these years historically, 1 year later, has been a double-digit return, a lot of them in the 20% plus range. This year, we're seeing very similar rate of return based on where the S&P is and how much the government has stepped in to help and where we actually see the market going next year. So what should we do? Well, statistics show that the best penalty kick strategy for soccer is for goalkeepers to stay in the middle, but yet we jump left or right 90%, 94% of the time. Well, if you look at the bear markets, this shows a past history of all the different bear markets that we've gone, which is a 20% drop or more in the market from current levels. Well, if you look at the 1 year after time frame from when this has happened, you'll see that every time frame has been a positive rate of return, and once again, an average rate of return of about 41.8%. When you expand that to 3 years after, your average annual return is 16%. That's a phenomenal rate of return, yet, once again, the people jumping left or right, people try to time the market maybe too much, where they may sell out at the bottom or panic instead of just holding things steady or being diversified. Now, if we look at where we're at today, stocks still are near all-time highs, but when you have a little bit of a consolidation like we've seen in the market where earnings start to recover, but the price still remains stagnant or stable, that does help to allow the market to expand, especially where we see rates as low as they are. And right now we're seeing the average dividend yield of the S&P almost at an all-time low. We're seeing treasuries at an all-time low. And we're actually seeing PE ratios not out of whack where we would typically expect them to see, like in 2000, where they got up to the 40-plus range. Now, that's not without being said that there aren't opportunities in the market when you do come into a bear market. One of the things that typically is very attractive is going into the asset classes that have the most growth potential when you're coming out of it. And so you see the 4 largest here are typically small cap coming out, large growth, U.S. stocks overall, as well as large value. Well, going into September, we'd only seen large growth outperform. Really, when you look at the various asset classes in the market, small cap and large value were underperforming by quite a bit going into September. However, with that rotation we saw in September, you had the opportunity to lock in some gains in large cap growth, diversify down in the small cap and large value, and we've seen 10% return since then, where tech's still trying to recover to where it was at the highs the first week of September. But you find these opportunities present themselves that are very unique all the time. Another area that we found very attractive was in the high yield sector. So in the first week of April, one of the shifts that we did for a lot of people was investing in the high yield index, because the spreads of high yield over investment grade not only broke 800 basis points, which is what this chart on the right is showing you, actually broke 1,100 basis points. And the worst performance you've ever seen following a spread that wide in the high yield market was 9.7% annualized return positive. It's never had a down year over a 3-year rolling period with spreads that wide. And so it became very attractive for us. And once again, not only were you getting appreciation there, but you're getting yields of about 9.5% at that time frame. So there are opportunities where, not saying you should go to cash, but you can find opportunities within the market to be a little bit more tactical and take advantage of these opportunities. And that's where, once again, if you can be greedy when others are fearful, there will always be opportunities, but also the opposite is always true. Be fearful when others are greedy, like we saw with tech going into September. So one of the questions we get a lot, and we manage a lot of fixed income for clients as well as institutions, is where do we go now with rates as low as they are? And if you look at these low yields in today's market, what we're seeing more and more investors pushed into riskier assets, either into stocks that are dividend paying, preferred stocks, high yield market. We're seeing a lot more hybrid securities. It's a very interesting time frame, and we're expecting that rotation from safety to risk to only increase once we get past the election and that uncertainty has been priced out. And based on the Fed minutes and what they have discussed, we actually see that 2023, 2024 is probably how long we're going to see rates this low, unless we randomly see the 10-year Treasury bounce back or the yield curve steepen on the long end. We expect these to be low. So people who are looking for income from their investments to live off of, we have to be very strategic in what we're doing. Unfortunately, your typical bond fund or CD is just not going to be able to do it anymore to generate enough income for people to live off of, especially in an after-tax standpoint. So another thing that we get asked a lot is, how do you view about the market going into the end of this year as well as next year? One thing that people tend to forget is what is on the sidelines right now. So we've seen the market move up quite a bit, and a lot of that has actually been because of institutional investors taking more risk in the market when the market dipped, like pensions, for example, like TRS, TMRS, ERS, they all increased their equity allocation. However, when we look at brokerage accounts across the country in the major wirehouses or relative discount brokerages, we have the highest amount of money market funds that we've had in history. And today, in the most recent end of month report, about 14% of all investment accounts had cash in there. I mean, it had about a 14% average cash rate in a brokerage account, meaning there is a lot of money on the sidelines waiting for a dip. And that's why ever since the crash, if you look at every time the market has started to drop in this recovery, right around 10%, we see more cash moving into the market. And we just saw it again last month. There is still a ton of cash to be in this, waiting for a dip, waiting to buy into the market, and any volatility is going to give people that opportunity, which pricing in, if you had about 10% or about bringing that 14% down to 4%, you'd see the S&P above 3,600 if that money entered the market, as an example, which is why once you get past the election, it's still a good time to look at being bullish in the market long term, especially coming out of a bear market. Now, as far as equity valuation, a lot of times you may look at the media and they may say stock prices are so overvalued or the U.S. market is so overvalued. And it is in a sense. However, the U.S. market makes up less than 50% of the global market now. And we are seeing very attractive opportunities, especially in the emerging markets, in the frontier markets. You're looking at Russia here, you're looking at South Korea, which is a developed country, looking at Singapore, Mexico, China, still trading at very good discounts to relative PE valuations, especially compared to the U.S., and we find a lot of opportunities out there if you're willing to take the international emerging exposure. And people tend to forget that 2003 to 2007, emerging markets did triple what the U.S. did as far as growth goes. And we're starting to see that kind of rotation from a valuation standpoint, putting itself together for another repeat of what we saw over a 5-year time frame. The other thing that helps us view this as an attractive opportunity is what we saw in the first part of this year from emerging market stock fund flows, which we saw a huge outflow going into the last 2 years, which is why you've seen emerging markets, as well as small caps actually, trading below their highs in 2018, which historically when that has happened, you look at a 3-year performance and you're seeing about an average of 15.6% annualized return over a 3-year following this kind of outflow, which once again is a reason why people should look on the equity piece having emerging market exposure. And we also see attractive yields in emerging market debt as well. And so when you look at a rolling 10-year performance and we combine even developed with emerging, you still see that there is a lot of opportunity rolling out of this past 10-year history that the next 10 years you're going to see a large outperformance on the international markets versus the domestic market. Now, as far as opportunity goes in fixed income. We talked about high yield, and the red line here is the high yield index. The blue line is the investment grade index. And when we look at the red line, we're still seeing yields of about 550 basis points, or 5.5% in that space. However, with the investment grade corporate, it has come down to closer to 1% right now. So to get to, that rule of 4, you have to look at a combination of the two, but there have been some attractive opportunities that are investment grade that you may find in the institutional preferred or in the preferred space that are attractive. But what's interesting is in the municipal space, which is the tax-free bond market, high yield spreads have actually not condensed. And the investment grade side has barely condensed as well. It's condensed a little bit more, but owning a high yield index in the muni market, which you can be very diversified, spread across 1,000 different holdings, you can still find yields where an after-tax equivalent could be the same as earning 5.5% in high yield corporate market or even higher. So we're seeing very attractive opportunities there that have the opportunity for appreciation as well as income. And a good example is JP Morgan runs the largest ultra-short corporate bond ETF in the world, JPST. And they have a municipal equivalent, tax-free, that's same investment grade as well as same duration. However, it has the same exact yield as its corporate equivalent, but it's tax-free. We have not seen that kind of dislocation in the municipal market compared to corporate markets in a very long time, going back historically, to where you're getting tax-free yield at the same yield as a corporate, even though you get a tax benefit to it. And these show us some of the details using that same example of where these different asset classes have done year to date, what the return was from that drop when you look at the February 19 to March 23rd drop, return since March 23rd, what the volatility looks like. And what's interesting about this is it shows us a lot of the opportunity we're still seeing from those asset classes, as we talked about in a previous slide, where emerging markets becomes very, very attractive. Emerging market debt has become very attractive from an opportunity standpoint. And historically, they have done extremely well in these cases, but they have not had the rebound yet that they historically would have had, meaning there's still quite a bit of upside in those opportunities. So, how will the election impact investing? Well, historically, there has not been any proofread journal or published article that's been peer-reviewed that's been able to prove a statistical significance of a political party versus another in the presidential as well as in the congressional sections. And so what we typically see is there is more volatility going into the election because of uncertainty, but the market still does well following the election. And looking at the annual average return, stock performance tends to do very well in presidential election years. It tends to lag actually in the midterm election years, but the non-election years, it still does well going into a next year, for example. Well, when we look at same party versus divided government, when you look at a one-year time frame, they're pretty same. Once again, people are trying to figure out how they're going to work together from a policy standpoint. But when you look at a same party, there can be some benefit to it, once again, because policies are actually getting passed and people are actually starting to work together. So it ends up being pretty attractive. But over 3 years, there's not much difference, just tends to be in that 1 year. However, getting to the point of up to the election, we tend to see the performance lag. Coming out of the election, we tend to see the market does a lot better, especially going into the spring. And that happens because the uncertainty is gone. Whether you're a corporation and you're working under a Democratic policy or a conservative policy, doesn't matter. You at least know which policy you're going to be working in, you're going to be budgeting for, you're going to be prepared for, and you have a lot clearer light of where I need to take the business. and you tend to see a lot more people enter the market once they have a better idea as well. So, Matt, why don't you take us off with the estate planning and the tax planning piece of the presentation?
Sure. Thanks, Dennis, and thank you for that great information on the investment side. I do want to touch a little bit on some planning opportunities here as we see going into the next election. But first, just as was mentioned before, my name is Matt Anderson. I'm a certified financial planner, accredited investment fiduciary. I'm also an enrolled agent. And for those of you who don't know or not familiar, an enrolled agent is a person who has earned the highest privilege of representing taxpayers before the IRS. Yeah, and what a privilege that is. So let's go into some things here. Let me see a show of hands. Sorry, bad joke. We love to do these things in person, but obviously with the where we're at today, I want you to be thinking about a couple of things here. How many of you believe that having an appropriate structured estate plan is an important aspect of a successful financial plan? How many of you have a will? How many of you have a trust? And when's the last time you updated it? Has it been updated in the last 4 years? At TCG, we like to joke around that your trust and your estate plan should really be reviewed with every president. And how many of you have ever had to serve as an executor or I can never say that word, of a will for a spouse or a family member? So many of you have probably been in this scenario before. What do we think? Well, most of us believe that by the time we're 35, we should have a will, right? 74% of Americans who say they would be more likely to create an estate plan if it helped lower their family's taxes, which is near and dear to my heart. 71% of us think that having a well-thought-out estate plan would help them feel like a good spouse or a good parent. 67% of us say we're often concerned about our family's long-term financial well-being. And 53% of Americans say they'd feel more successful if they created an estate plan. So we're all thinking about it. We all know it. But what do we do? In 2019, less than 40% of older Americans had a will, an advanced healthcare directive, a healthcare power of attorney, or even a financial power of attorney in place. And it's actually less than that in 2020. And the wealthy are no different. 10% of Americans earning between $100,000 and $150,000 have an up-to-date will, and only 15% earning more than $150,000 have an up-to-date will. So what's holding us back? Well, the overwhelming majority of us just haven't gotten around to it, right? It's in the future. You know, it's way down the road. I'll worry about it when I get there. A lot of us think, well, we don't have enough assets, you know, to really take care of. We don't really have anything to protect, which we all know is not true. So why should we do it? Why should we have a proper estate plan? A will, a trust? What if tomorrow never comes? Most people underestimate their net worth. You know, what about your house? I know this year the housing market's gone gangbusters here in the state of Texas. Quite honestly, you can't afford not to do it. And for a lot of people, the barrier to getting started is just knowing how to get started, right? You know, how do you avoid probate? How do you meet an attorney? How do you talk to a financial planner? Do most of you understand how probate works? Do you know where to file? You know, do you know if you need an attorney or if you're working with a recent version of a will or trust? A will is a great thing, and it's something that we all should have. But it's really just a document to take to court, and so are we prepared for that? Do you have property in different states? As mentioned in my bio, I am that guy from California. I apologize ahead of time. However, my wife is from Texas. She went to school in San Marcos, so I kind of feel like I have an in. But I work with a lot of clients, obviously, across multiple different states, California being a dominant one there. And for clients that have, you know, who have transplanted from California to Texas or from New York or from all these other states, what happens when you have properties in different states, and do you have that protected? And again, as I mentioned, do you know the differences between a will and a trust and what's right for you? I put together this estate planning checklist. Feel free to take pictures with your cell phone, screenshot, you know, whatever. I think this is a really good list of things to be thinking about for your own self and your family. You know, do you have a current will? You know, when's the last time you updated it? Have you renamed your beneficiaries? You know, things happen. We get it, right? Divorces, you know, people get remarried. You know, have you made sure that you have the proper beneficiaries listed in all of your retirement accounts, all of your bank accounts, your house, you know, whatever it might be? Have you created a letter of instructions for your beneficiaries? Do your beneficiaries know where your assets are? Do they know where to go and who to talk to should something happen? Are your documents stored in digital format? This is a big one. You know, a lot of us, you may have come across this before, you know, our grandparents may have had wills or trusts stuffed in a desk drawer along with some stock certificates. We live in a digital age now. Making sure that you have everything in digital format is important. In the case of a trust, do you have a corporate trustee or protector, or do you have a family member looking after it? You know, are they the right person to do so? Might be a good time to take a look at that. Is there a plan or a team in place if someone contests the will? You know, believe it or not, we come across that quite regularly. And if you're a business owner on the call, you know, do you have the planning in place to ensure that both your business will survive as well as your family? You know, have you looked into, you know, what risks you might be exposed to in that sense? Now, I'm going to leave this slide on here. I do apologize, we don't have slides going forward, but as an enrolled agent, and because we did talk about, you know, the upcoming election, you know, sort of keeping with the theme of the opportunity in a world of uncertainty, I wanted to touch on some of the potential tax changes that could happen should we see a change in the White House. Democratic presidential nominee Joe Biden has released a tax plan that would seek to increase taxes on high net worth individuals. Now, again, this is only a rough draft and likely will never be fully implemented. They never are. But it's important that we look at them just in case some of these changes do take effect. And of course, too, Congress is the one that writes bills. They pass budget bills and write tax codes. So the House and Senate do have a say here. But, you know, if Biden is elected, tax policy outcomes will heavily depend on whether the Democrats take majority in the Senate. Okay? So, in general, the available information about these proposals is limited. It's clear, however, the overall plan will include a number of complete or partial repeals to President Trump's 2017 Tax Cuts and Jobs Act. It's also unknown when these proposals will take effect. It's commonly accepted tax law changes usually are passed, you know, the very next year when someone comes in. It doesn't matter if they're passed in the summertime or in the wintertime, they would essentially take effect for the entire 2021 tax year. So let's go over some of the personal income tax provisions that we're seeing. One is long-term capital gain rate and qualified dividend rates would be taxed at ordinary income for those taxpayers with more than $1 million in taxable income. This would eliminate the long-standing 20% preferred rate for long-term capital gains and qualified dividends in those highest brackets. So what's the opportunity there? Rebalance your portfolio, tax loss harvest your non-qualified accounts. Look and see where to maximize your portfolio income this year prior to potentially paying double in taxes next year. A repeal of the Tax Cuts and Jobs Act for taxpayers with income over $400,000. Essentially, taxpayers who are married filing jointly, they're currently either the 35% or 37% brackets. We could see that rate increase to 39.6, which was essentially a repeal of the Trump tax reform. So what's the opportunity here? Potentially Roth conversions, insurance product distributions. If you're in a lower tax bracket now, take advantage of it. With marginal rates potentially on the rise, and no doubt continuing to rise from there, those are considering converting assets to Roth for estate planning purposes or maybe Social Security planning. May want to talk to your advisors or your tax professionals and see if this makes sense for you. There is talk about reinstituting the PEAS limitations on itemized deductions for taxpayers with income over $400,000, and then cap the value of those itemized deductions at 28%. That's a lot of big tax language. Essentially, it's alternative minimum tax coming back. So under the current law, itemized deductions are not subject to this limitation. Deductions are valued at the taxpayer's top marginal rate. So what's the opportunity here? Well, charitable gift giving. For those of you who are charitably inclined, you may have already seen a reduction in your itemized deductions, a reduction in your tax benefit due to the SALT cap, the state and local income tax cap. And we're not seeing any changes to that going forward, but we are seeing this additional 28% cap on itemized deductions. So front loading your charitable contributions in this year and stretching that out over the next couple of years could be pretty powerful from a tax saving standpoint. And for our business owners on the call, a potential phase out of the QBI deduction, Section 199, could potentially happen with those who have an income over $400,000. So the QBI deduction is for those taxpayers who report business income from pass-through entities like LLCs, S-corps, and so on. So what's the opportunity here? Revisit your corporate structure, of the business, determine whether or not you're set up best to maximize your after-tax income going forward. The new tax reform potential, I guess just to say, tax reform does call to eliminate the tax deductibility of 401k and IRA contributions and replace that deduction with a credit. Now this is a big one, and this one probably pertains to every single person on this call. The credit would be equal to the amount of the contribution multiplied by a fixed percentage. We don't know what those percentages are just yet, but it's very different than those in a high marginal tax rate. So the idea here is to increase deductions for lower income households while increasing or decreasing, the deduction for higher income households. Because if today you're in a 37% tax bracket, you get a 37% write-off essentially for every dollar you put into your pre-tax 401k, IRA, 403b, 457, etc. That could be reduced to a standard credit, which will more than likely be significantly less than 37%. So what's the opportunity here? For those of you in those higher income tax brackets, just make sure you fully fund those accounts this year. Don't put it off. Another thing we're seeing is an elimination of the stepped-up death or basis at death. Essentially, all this means is that your house, your stocks, other capital assets like that, if something were to happen to you, your beneficiaries get the benefit of stepping up what the basis or essentially what they paid for that asset. So if you bought a house for $50,000, you pass away, it's worth $200,000, your beneficiaries get that house at $200,000. If they sell it that day, they don't have a tax burden. It's just one of those things that's been worked into the tax code for many years, which is a benefit to some. However, they are looking at taking that away. We don't know if that will trigger any additional taxable recognition events. For instance, increasing your marginal tax bracket with that inheritance. So the opportunity here, going back to charitable giving, it used to be somewhat unattractive to give to charitable trusts because you lose that step up in death basis. So what we want to look at is, now that we don't have that as an impediment, do we want to look at reducing our estate by making those charitable gifts, giving to family members and all that earlier on, especially because we're also seeing that more than likely the current $11.6 million gift and estate tax unified credit is expected to go back down to 5.8. So there's going to be a lot of really important estate planning decisions to make over the next 4 years. And then lastly, I wanted to touch on payroll tax. So we all know we're subject to payroll tax. You see it on your W-2s, FICA, FUTA, Social Security, Medicare, those things. So wages above $400,000 are going to be subject to a potential additional 6.2% payroll tax. Self-employment income would also be subject to this tax for those making over $400,000. This creates kind of a donut hole because right now we have that $137,000 cap where we pay Social Security tax, Medicare and such up to that number, and then we don't pay anything else on that. For those who make more than that, know that you pay that additional small Medicare tax. But now it's looking at once you exceed $400,000, there's an additional 6% that may come back in there. So just something to be ready for. Those are most of the changes that we're seeing right now. We're kind of keeping our eye, obviously, as we get closer. But with that, I'll turn it back to Dennis.
Thanks, Matt. Really appreciate it. Ray, just wanted to check with you. Do we have any questions come across?
Yeah, guys, that was a lot of information. There's a few questions that have come through. Let me ask some of these quickly. And for anybody on the call, if you still want to schedule or want to submit a question, you can use the Q&A icon in the bottom of your screen. Dennis, this question says, what should people watch from a planning standpoint?
Yeah, anytime you go through a year like this year, I think one of the biggest mistakes people make is they do a financial plan one time. And that plan tells you, hey, here's what you should do for the next 30 years. As long as you follow this, good luck. Well, the problem is life changes and major events change. Well, I guarantee for anybody this year, 2020, life has changed at least a little bit. Whether it's work related, whether it's personal related, life is different. You should be looking at that plan ongoing. You should make sure that anytime you have a plan, you're not just taking a plan, putting it on the shelf and saying, hey, I'll check it once a year, but making edits, making modifies to it. It should be more like a business plan. And you should look at it to say, okay, how did we do as a business? Did we outperform? Did we perform like we expected? Did we underperform and need to change some things? But I would really encourage people from a planning standpoint is take a look at it and start from scratch to say, okay, how did we do? Would we change anything about it going into next year? And once again, that's what we're here for, not to just give people a plan, but help them live a plan.
Excellent. Matt, I think this question is for you, actually. It says, is it good to use LegalZoom when creating my will?
Excellent question. I think that so many of these great companies come out in recent years, LegalZoom, TurboTax. There's so many, do-it-yourself options out there that I think are a great idea to explore. It's good to look at your own scenario. I will say that LegalZoom would be a great option for something very simple, very basic, right? Just to get a pen on paper to say I want something official, something legal, to honor my wishes. If you have anything in your life, in your family plan that might be a little bit more outside the box, you've got multiple families, multiple kids from different parents, anything that might be a little bit different, you may want to look at, seeking an advisor or talking to someone about your scenario. Excellent.
There's a few questions about wills. This one says, who can we contact if you want to discuss creating a will?
Excellent question. We make ourselves available for that. Obviously, as proud partners now of Firstmark, we want to make sure that we're helping all of our clients with those estate planning needs. Wills can be, honestly, as simple as just going onto the texas.gov website and printing out a blank will form, getting it filled out, and getting it notarized. So at a bare minimum, that's something that everybody should do just so they have that. But again, just like I said with LegalZoom, once things get a little bit more complicated from there, you want to make sure that you sit down and talk with someone to see if there's anything more required or in your best interest.
Excellent. And this one maybe you might have answered, but still worth asking. It says, I made a will in 2011. Is it worth updating it?
I would. Going back to, what I had mentioned on the slides there, we like to say with every new president, you should probably update your estate plan. And it's updating your estate plan might be as simple as reviewing your will, everything looks good, put it in the drawer. But you might see something in there that you forgot about, or you might have acquired more assets since then, new cars, new houses, new accounts. It's always just
family members. More
family members, exactly, good point. So I would definitely review about every 4 years is a good rule of thumb.
Excellent. Another question says, are there any sectors you should avoid these days?
Yeah, so great question. So going into the election, the two areas that kind of stand out for us is oil and gas and small and regional financials. The reason for oil and gas, it's not just, going into election and expecting some increased regulation there. We've already seen some of that with the Dakota Access Pipeline. But it's hard to believe we're going to see oil demand and growth come back to previous levels that we saw going into this year. BP came out and announced they don't expect it to ever come back, that it'll be lucky if it stagnates for 5 years. We're seeing states starting to require no gasoline fueled cars to be created after 2030. We're starting to see Ford, GM come out saying that every car they'll sell by 2030 will be electric. So you're starting to see that shift already to clean renewable tech. And then small regional financials, simply because regulations haven't come down and hit that area as much as it has large financial companies. And I think going into or coming out of COVID, I think a lot of regulators are looking at those areas saying those were the higher risk and less well capitalized compared to the large counterparts. So we expect increased regulation to come to those areas. Those would be two areas that we'd stay away from. If you want to be in energy, look at clean renewable tech. It's something we've been touting for a few months now. Look at 5G, look at some of those other areas.
Well, Dennis, that seems to be it for questions on our end. I'll send it back to you.
Well, thanks everyone. From TCG, we really appreciate everybody taking the time to tune in today. Thank you first, Mark, for having us on. We look forward to the next one. If you have any questions, please email us at advisors@tcgservices.com, and we look forward to helping each and every one of y'all. Thank you again.